I see companies brag about revenue, but sometimes they still lose money. What's the income statement actually telling us?
It's the company's report card over time, usually a quarter or year. It shows all money earned, all costs paid, and what's left is profit. Think of it as a video of cash flowing in and out.
So where do we start reading? Is revenue really the most important number at the top?
Revenue is total sales, the top line. But it's not profit. You must subtract costs step by step. First, cost of goods sold, or COGS, the direct cost to make what you sell, like materials and labor.
Got it. So after subtracting COGS, what do we call that number, and why does it matter?
That's gross profit. It shows how efficiently you produce each item. A healthy gross margin, gross profit divided by revenue, means you keep a good chunk of each dollar before paying overhead.
Then what comes next? I assume there are more costs beyond just making the product.
Right. Next you subtract operating expenses, salaries for office staff, rent, marketing, research. What's left is operating income. This tells you if the core business itself is profitable, ignoring taxes and interest.
I've heard analysts mention EBITDA a lot. How is that different from operating income?
EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It strips out non-cash charges like equipment wear and tear. It's a rough proxy for cash flow from operations, but it ignores real costs, so use it with caution.
Let's make this real. Can you walk me through a quick example with a coffee shop?
Sure. A coffee shop sells $100,000 in coffee. Beans and cups cost $30,000, that's COGS. Gross profit is $70,000. Rent, wages, and utilities run $50,000. Operating income is $20,000. After interest and taxes, net income might be $15,000.
So net income is the final bottom line. But why do some companies show net income yet still go bankrupt?
Because net income includes non-cash items like depreciation. Cash flow is different. A company can show paper profit but burn cash if customers don't pay. Always check the cash flow statement alongside the income statement.
What are the biggest red flags you look for when scanning an income statement?
Watch for revenue growing faster than cash collections, shrinking gross margins, or one-time gains boosting net income. Also, if operating income is flat but net income jumps, ask why. It might be from selling assets, not real business.
So how do we know if a company is actually improving over time? Is one quarter enough?
Never judge on one quarter. Compare year over year, same quarter last year, to smooth out seasonal swings. Look for consistent growth in revenue and operating income. A single great quarter can be a fluke.
For a beginner investor, what's the single most practical takeaway from all this?
Focus on operating income and its trend. That tells you if the core business is genuinely making more money. Ignore headlines about revenue. If operating income grows steadily, you're on solid ground.
And if operating income is falling but revenue is rising, what should I do?
That's a warning sign. Costs are growing faster than sales. Dig into why. Maybe they're investing for growth, which is fine, or maybe they're losing pricing power. Always read the management discussion in the report for context.
Perfect. So my homework is to pull one income statement and trace it from revenue to operating income. Thanks, Jordan.
Exactly. Start with one company you know, like a coffee chain. Write down each line, calculate the margins, and compare to last year. You'll learn more from one real statement than 10 textbooks.